Hello, good evening everyone. How are you? So before I start, I want to wish everyone a wonderful and happy Diwali. So this Diwali should bring in lots of lights. It should bring in the light called enrolled agent. EA light should be lit upon your life. All your darkness should go away. Darkness with respect to finances, darkness with respect to knowledge, everything needs to go away, and then EA light needs to be lit in your life. So let's hope and pray that will happen this Diwali. Okay, wishing you a wonderful Diwali this year. Okay, so let's look at what is the thought for the day. It's all in your head. Just take a minute before we jump into the class. So, is it all starting in your head or ending in your head? Yes or no? Any thought, any goal you want to take up, and then if you are able to achieve it, again it's in your head. If you are not able to achieve it, who's stopping you? Who's stopping you? Is there somebody other, any third person or any external entity is putting their leg on your throat and then crushing you in order to not to achieve that goal? No, right? So a simple petty thought is what stops. Difference between a success and failure, it's all in your head. So if you're, let's suppose even after putting all your efforts, you have failed a particular paper in EA. Okay, so what happens? The hell broke loose and everything got vanished. Is it nothing? There is no restriction on the number of limits that you can take, and I'm not saying you'll fail, but I'm saying your mindset and your thought process, if it is aligned in the right direction, you will understand what is the root cause. Why did I fail? I've prepared everything. Achha, these are the hard topics for me. Study it once again so that you'll have that hands-on practice, and then you can serve the clients better. So either see any problem that comes, there'll be two things. You'll be either on the problem side or you'll be on the solution side. But you're on the solution side, things will move forward. If you're always stuck on the problem side, you'll be stuck in your head. That's all. So remove all those petty thoughts, move forward, and do not lose your focus in preparation of paper 2. Okay. Having said that, let's get into our topic for today. So we are starting domain 2 as per Prometric, business expenses. Yes or no? We're starting business expenses, right? Just a minute. Okay, what business expenses are like? So let's understand what are we studying now. So please put the heading. Please put the heading. So until business types and entities, we have covered domain 6. 6 domains were done. Now domain 7, business expenses. Domain 7, business expenses. So any business that you start will have business expenses, right? So from in EA part 2, we are trying to understand any entity, what are deductible, what are not deductible, what are startup costs, organizational costs. In terms of expenses, what all we can claim. What are again it will all come to ordinary gain, capital gain treatment, all the business expenses, what all goes into, we'll understand in detail. So out of the all three domains, business expenses will have the highest weightage in questions. 37 questions out of 85 as part of part 2. So business expenses you can mark it as very important, and then These expenses, this content will help you in real time also when you're doing in practice. Somebody has already asked you for entity. What kind of entity I need to incorporate or organize? You have already advised him what LLC you want to incorporate. A LLC, are you a sole proprietor, or you a partnership, or you a C corporation? Once you have done that, that bookkeeping needs to be done to understand income and expenses per year. What is the income that he has generated, and what are the expenses that he has incurred? So all those books are with you. You will have to understand where did my money go. Even in our middle class this thing, after the end of the month, we'll try to understand ఎంత వచ్చింది ఎంత వెళ్ళింది అని చిన్న will make a short income and expense statement, right? Profit and loss statement. So like that, business also needs to be taken care. How much did we earn, and how much we have incurred as expense. So we'll understand everything in detail as part of business expenses. Please write first unit 1, business income. Unit 1, business income. See, I want you to please write down this particular thing, because this is what will happen is this is not as plain vanilla as business entities. Okay, so this requires some kind of understanding for you. So I'll make sure what is important and what is not important. I'll let you know, so that I'll pause the video and then you can take a screenshot and then you can write, or pause the video and you note it down. Okay, is it too small, or how is it? Is it okay, or should I increase the size? Okay, is it okay? All right. So what are passive activities in general? Publication 535. Please note down publication 535 and then download this particular publication. Publication 535. What are passive activities in general? So 535 talks about all kinds of business income, and this domain in total it will cover. Publication 535. First question: what are passive activities in general? So something, see, in general English meaning, what is passive? Which is not active. Active income, passive income. So something which you are not putting your sweat and blood and you are not earning, just passively it is coming without your effort. So we'll understand what is earned income, unearned income. Earned income is where you go daily, work for it, and then you earn the income as part of your salary, whatever. Anything earned is earning, wages, right? But unearned income is, that is also an income, but you are not getting that income by putting your blood and sweat. Let's suppose you have put some FDs in the bank. That is also income. You are getting a interest out of it. Let's suppose you bought a stock in Ford, Tesla, Apple. They gave you a dividend. Tesla is doing very well. That is also income. Did you go and work for Tesla and then got the income? That is a unearned income. So that is called as portfolio income. Basically, it's called portfolio income. Portfolio income is interest income, dividend income. All that comes under unearned income. Earned income is wages, salary, self-employment income. All that income is earned income, where you put in your efforts, your talent, your hard work. All that is required in order to generate that income. It is called earned income. Got it? So we are trying to understand what are passive activities. Passive activities from an entity perspective. Some business activities are considered passive in nature and are subject to passive activity limits on the deductibility of losses. Let's suppose your business has, see, passive activity losses. There is a rule where you can offset your passive activity loss only with your passive activity income. You cannot offset it with your general ordinary income, meaning your active income. You cannot go and offset it with your wages. That loss that got generated is due to passive activity. Let's suppose you have started a business and then you have incurred some kind of a loss. See, passive activity is you have started you have an apartment that you have rented out. So whatever income that is being generated out of that rental apartment, is it active or passive? You are not working for it, right? That rental income is coming every month. So let's suppose you have incurred loss. There are no tenants. You kept on that you have kept the flat vacant, and then you kept on paying property taxes or whatnot. So you have incurred some kind of a passive activity loss. So something happened, maybe tsunami came or whatever. You started a business and then that did not go well. You are not active member in that partnership, but then you are just a limited partner, and that's a passive thing. So whatever passive loss that is coming in from that activity can be offset only with passive activity income. Let's suppose you have some dividends or you have some interest income. You can offset it only with the passive income. You cannot offset it with general earned income. That's a rule. Passive to passive, active to active. Okay. So these passive activity loss rules are designed to prevent investors from using losses incurred from income producing activities in which they do not materially participate. So any activity, so passive by definition is any activity if you are actively participating, it is active participation. So in passive activity, you will not materially participate. Maybe in a partnership, maybe you have invested, and then 3 other partners are working. They are all materially participating. You are not materially participating. For you, it will be a passive activity. Correct? For others, it is active participation. Maybe they will be getting salary out of it. Maybe it is a S corporation. S corporation needs to pay reasonable compensation. So material participation is required. So whichever activity is not materially participated, it is passive activity in nature by definition. So the passive activity rules apply to whom? TIE. TIE. Passive activity is for TIE. Trusts, estates and individuals. Other than grantor trusts. Personal service corporations and closely held corporations. So what are the kind of passive activities? There are basically 2 kind of passive activities. One is passive business activity. 2 is rental real estate activities. So these are classified as passive activities in businesses. One is these are trade or business activities in which the taxpayer does not materially participate during the year. In which the taxpayer does not materially participate during the year. So passive business activity is, these are trade or business activities in which taxpayer does not materially participate during the year. So what are passive business activities? These are trade or business activities in which taxpayer does not materially participate during the year. Again, one more kind of passive activity is rental real estate activity. Rental of real estate is generally passive, even if the taxpayer participates in the activity, except for bona fide real estate professionals. See, passive activity is of 2 kinds. One is passive business activity, and 2 is rental real estate activity. So any activity in which you do not materially participate is called passive activity. So there is one distinction. Even though there is one exception, that is the rental of real estate is generally passive. Rental of real estate. See, real estate when you hold, it is not same as the holding your personal property. Rental of personal property is passive. Okay. Even if the taxpayer participates in the activity, you cannot consider that particular real estate activity as active. Why? There is a distinct distinction between material participation and just participation. See, material participation is of the highest order, meaning, let's suppose you have worked for 750 hours on that particular specific activity, meaning that is your main principal business activity. Only then it is called materially participation activity. Just you are being active, taxpayer is participating in that particular activity actively does not mean he is materially participating. It should be their primary source of income. You are doing a W2 job, then in rental also you 1 or 2 hours you are spending. You cannot say I am materially participating. You are actively participating, but then it is not material participation. such activities will be considered as passive activities. You cannot claim it as the active main source of income. So these, even though rental real estate is your main this thing, you need to be a real estate professional in order to earn main source of income from such activities. So these are called passive business activities, rental real estate activities. These two are deemed to be passive activities. Okay. So I'll just pause for a moment. You can just note down. So let's look at an example. Rohit owns two residential rental properties. He also has a full-time job as a postal worker. So how many residential properties does Rohit have? And he also has a full-time job as postal worker. He actively participates in the rental activity by personally collecting rents from his tenants and checking on the properties on a regular basis. But he is not a real estate professional. His main source of job is postal worker. He is a full-time job as a postal worker, but he owns two residential properties. So he collects rents and all. But then just because you went there to high-tech city and you have collected rent, you cannot say I'm actively participating and this is my real profession. Okay. He reports income and loss from his rentals on Schedule E. He reports his income and loss from his rentals on Schedule E, and his rental activity is still considered a passive activity. So what happens usually? Let's suppose you are you are saying I'm a real estate professional. So if you are generating income and loss from that particular real estate activity and you are a real estate professional, you will report all this income and loss in Schedule C. Schedule C is for profit and loss, where you show income and expenses for a sole proprietor or for a LLC, because that is your main source of income. Okay, that is active income. That is your active, but you are not a real estate professional here. All the passive income, rents and royalties will be reported usually on Schedule E. Because it is not your active this thing, it is passive, it will flow to Schedule E. You are understanding the difference between passive and active, right? Only if it is active and main source of income, you are materially participating. Only then it goes to Schedule C. Because you are not a real estate guy, this particular income and loss from his rentals go to Schedule E, and his rental activity is still considered a passive activity. The rental income is not subject to self-employment tax. Why? It is not being reported on Schedule C. So Schedule C, if it is main this thing, you will have to pay 15.3 self-employment tax, because that is your main job, your business. Your business needs to report self-employment tax. Any income that you are generating needs to pay tax, correct? So if it is a W2 income, this self-employment instead of self-employment, FICA taxes will be withheld by employer, Social Security and Medicare. So if you are not, in case of self-employment, you are the employer and you are the employee. So nobody else will withhold your particular FICA taxes. So you yourself have to withhold and then pay to the government. So instead of 15.3, you will pay 7.65. Why? Government says, I'll give you some deduction because you are the employer and you are the employee. I'll give 1/2 deduction, you pay the rest of the 7.64%. Next question. Define non-passive activity income. Define non-passive activity income. So generally, we are trying to understand. We looked at what is passive activity income in the first question, right? So what is not passive activity income? Something which is active. Yes or no? So all the below incomes will be treated as non-passive activity incomes. What are those? Portfolio income. You please remember this verbiage and terminology. Portfolio income, personal service income. All these are important when you are trying to understand a multiple choice question, a case study. In a question, they'll bring up a scenario. Basically, they'll try to put up all these words. If you do not understand the real concept and the meaning of it, you will not be able to understand the whole purpose of it. Okay. So What is portfolio income? Interest, dividends, annuities, and royalties not derived in the ordinary course of a trade or business, or gain or loss from disposition of property that produces these types of income, or that is held for investment. Basically, interest, dividend, annuities, and royalties, what all income that we generate is called portfolio income. So there is a distinction between passive income and portfolio income. So by law, IRS has defined this particular income as portfolio income. So we cannot just interchange these words like I need to get passive income like FDs, interest, and dividends. That needs to be termed as portfolio income. Okay. Personal service income is not passive activity income. What is personal service income? Personal service income. You are providing personal services and you are generating income out of it. What are personal services? It can be anything. You can be an accountant, you can be a CPA, you can be a EA, you can be a product manager, you can be a programmer, all the attorney, lawyer. So all the services you will be providing, right? So out of that, you will be earning some kind of income. That is an active income. That is not passive activity income, right? So it includes what? Salaries, wages, commissions, self-employment income from business, deferred compensation, and guaranteed payments from partnership to partners for personal services. Let's suppose there is a partnership. 3 of your friends have formed a partnership and you are a limited partner. So you are an enrolled agent. So your partnership got a notice from IRS, got a love letter. So your other 2 members will not understand what is that notice, and they want you to reply back to IRS. Handle this particular notice because you are an EA. You please handle this particular notice. But then what you will say? You are a limited partner. Those 2 guys are actively working. You will say, pay me $1,000 for this, and then I'll reply to IRS, and then I'll close this. That is called guaranteed payment. To hell with your partnership, to hell with your partnership income. I need to get this much of amount of income in order to do this kind of service. That is called personal service income. So payments from partnership, guaranteed payments from partnership to partners for personal services. This is not personal service. You are getting a guaranteed payment from your partnership for personal service. What are you doing? You are representing your particular partnership. You are providing a personal service to them, right? Why? You are an enrolled agent. You are giving your representation rights to your partnership. So in exchange of that, you are asking for guaranteed payment. You look at what is guaranteed payment in partnerships, right? Whatever happens to the partnership, you will have to pay this much of amount to this particular individual, and then that is treated as an expense. Okay. Next, income from intangible property. So what are not passive activities we are trying to understand? Income from intangible property. Intangible is something we cannot touch. There is no physical thing. So patent, copyrights, literary, musical or artistic composition. If the taxpayer's personal efforts significantly contribute to the creation of the property, it is called income from intangible property. State, local, foreign income tax refunds. These are not passive activity income. So income from a covenant income from a covenant not to compete. A covenant not to compete is a type of legal agreement between 2 parties. Sometimes a business will pay another business or individual for agreeing not to enter into direct competition. So let's suppose Citibank and HDFC Bank is there. So one gentleman who has worked for Citibank for 40 years came out of the bank and then started his own bank, started HDFC. So Citibank will make sure that particular individual will not open that bank as a competitor for their own bank. So before promoting them to higher positions, they will write a covenant not to compete kind of an agreement. So whatever income that is getting generated out of that agreement is not passive. This is what we are trying to understand. Cancellation of debt income. If at the time the debt is discharged, the debt is not allocated to passive activities, it is not considered as passive activity income. So debt is discharged. Let's suppose your credit card payment is pending. You're due by $1,000, but you did not pay. and the credit card fellow is also in very good mood. They have discharged your debt. They have cancelled your debt. So 1099C will be sent. So that kind of an income is also not passive activity income. These terminology and this concept needs to be understood, because a multiple choice question can come. What kind of income is passive activity income? Four options will be there. So they'll be categorized in portfolio income there. They'll be categorized in cancellation of debt income there. You'll have to understand the literal meaning of it. Only then you will be able to categorize what is passive and what is non-passive. One small mistake will cost you the question. That is the reason we are trying to understand the basics of it. Okay. Please write the next question. What are passive activity losses? What are passive activity losses? So passive activity losses are very bad. Why? Because you cannot offset it with regular income. You have to offset the passive activity loss against only passive activity income. But your partnership or your business, if at all it is generating passive activity income, it is very good, right? Passive activity income need not pay self-employment tax. It pays only income tax. Schedule E income, whatever is being generated, it will pay only income tax. It will not pay SC tax, because it is passive activity in nature. That is not your main business. But when you are coming to losses, for the losses you will have to wait. Let's suppose you got $10,000 passive activity loss, and you do not have passive activity income of $10,000. You have only $2,000 of passive activity income. This $10,000 will be offset with only $2,000 of passive activity income. Rest of the $8,000 will be carried forward till you die. Next year it will carry forward to 8,000. Next year again you will generate 2,000 passive activity income. This will be deducted by 2,000. The rest of the income is $6,000. Out of $10,000 passive activity loss, you able to understand what I am saying? Passive activity loss will be offset only with passive activity income. Understood? No. Next step. It is not month. It is, see, it is all calculated from a yearly perspective. Yearly, you got $10,000 loss. Your passive activity income is just 2,000. Getting income from interest, dividends, and whatnot, that is only $2,000. That needs to be offset with only $2,000. So, what is the remaining loss that is pending? $8,000. That $8,000 you cannot deduct in current year. You have to postpone it for next year. Again, in the next year, let's suppose you got only $3,000 of passive activity income. That will be offset against 8,000. 5,000 is left. Again, that will be carried forward next year until you die. So that losses they cannot be deductible on the current this thing. That is the reason it is bad answer. But income is good, right? 15% self-employment tax you are avoiding, right? Straight away, only income tax is you are paying, no self-employment tax you are paying. Okay. So please write what are passive activity losses. Losses from passive activities that exceed the income from passive activities in a given year are generally disallowed as deductions for the current year. What did I say? What did I say? Losses from passive activities that exceed the income from passive activities in a given year are generally disallowed as deductions for the current year. So, no. Right? Your loss is exceeding your income. Your passive activity income is $2,000. Your loss is $10,000. So, your loss is exceeding the income. So, generally it is disallowed as deduction for the current year. It will be postponed to the next year. Understood? Next point. In general, passive activity losses are deductible only to the extent to the taxpayer has income from other passive activities to offset the losses, or when the taxpayer completely disposes of the activity. Suspended losses can be carried forward to the following year. subject to the same passive loss rules and limitations. Non-corporate taxpayers use Form 8582 passive activity loss limitations to summarize income and losses from passive activities and compute deductible losses. Do you understand what I'm saying? Yes or no? Passive activity loss are deductible only to the extent that the taxpayer has income from other passive activities. You see, anything you're trying to offset, both nature should be passive. Passive activity loss, passive activity income. So this loss can be offset only with passive activity income. The nature of income should also be passive. It cannot be your main business employment or your main source of income in which you are materially participating. So you can deduct only up to your passive activity income. Rest will go to next year until you leave. So all the individual taxpayers, where will they file this form? 85, 82. Passive activity loss limitations to summarize income and losses from passive activities and compute deductible losses. This is the form 85, 82. Passive activity loss limitations. Rental real estate activities with active participation. Activities with net income, activities with net loss. What is the prior year unallowed losses? What is it saying? Prior year unallowed losses. Meaning, in the previous year, whatever was disallowed, you will mention it here. So with your income, you will offset it again, and whatever is rest, this thing is again carried forward to the next year. Okay, understood? 85, 82. Please download this particular form. Next question: what is passive rental income? What is passive rental income? What is passive rental income? Passive rental income refers to the earnings derived from renting out the property or real estate that a person or entity owns. Passive rental income refers to the earnings derived from renting out property or real estate that a person or entity owns. Understood? This income is considered passive. Why? Because the property owner is not actively involved in the day-to-day management. So you are working for Big Four, and then you invested 20 lakhs FD. So out of that, whatever income that got generated, you bought a rental a flat. But your main source of this thing is working in Deloitte, let's suppose, as a tax manager because of a year. But this rental activity is passive or active in nature. For example, Rajeshwari is a wealthy retiree. Rajeshwari, wealthy retiree. She no longer works in a regular job, but she owns a partnership interest in multiple limited partnerships. She owns partnership interest in multiple limited partnerships. She is merely an investor and has no participation in any of the businesses. She is just an investor. Each partnership is profitable and she receives a Schedule K1 showing her share of partnership income, which she would report on Schedule E. Since she is a limited partner, she has the benefit of receiving passive income, which is not subject to. So this is a positive. For active income, you are supposed to pay self-employment tax, right? Schedule C. Because this is passive and you are holding real estate, it flows to Schedule E. And then you will not even pay any self-employment tax. You will just pay the income tax. So, no. So that is what is passive rental income. We go to the next question. What is business income? What is Although most income that a business receives is taxable, there are certain exceptions where income is deferred or not subject to tax at all. Most income that a business receives is taxable, yes or no? But there are exceptions which where income is deferred as in postponed. You are receiving the income this year, but you are postponing it to future this using there are some methodologies like 1031 like kind exchange, meaning there is a real estate property. For that real estate property, you will take the similar kind of real estate property and you will exchange both the properties. That way, you are not paying tax on the gain that have you received. You are deferring it for future years. That is called like kind exchange, 1031 exchange. We'll look at what is 1031 exchange in detail. There is an example I'm saying. Even though business has income, most of it is taxable. There are certain exceptions where income is deferred is postponed, or we'll avoid the tax completely. For example, a corporation or partnership may choose to invest in tax exempt municipal bonds. See, any income, even see, this will be asked in your paper 2 and then paper 1 also. There is a separate topic called incomes in paper 1. So we'll try to understand what is taxable income, what are the different types of income, what are tax exempt incomes. So municipal bonds, when you hear the term municipal bonds, the next thing that you immediately should recollect is tax exempt. Municipal bonds are tax exempt. Municipal bonds are. A corporation or a partnership may choose to invest in tax exempt municipal bonds just like an individual taxpayer. So let's suppose you want to reduce your taxable income for this year. You will invest in municipal bonds. These are government given. Municipality is what? So if you invest in that, we will give you an exemption. Why? Government is generating income. You will also reduce your taxable income. So like individuals, corporation or partnership can also invest in order to reduce their taxable income in municipal bonds. The interest income received from the municipal bonds would retain its character as a tax exempt income to the business. Businesses may also engage in a tax deferred transactions where the taxation of income is deferred to a later date. Okay. An example is section 1031 exchange. Just remember the exchange 1031 exchange as like kind exchange. Like kind. What is like kind? Similar. Like kind. It happens between two real estate entities. One is a building, other is a building. Raheja Mindspace, Norbit Mall. Both will exchange. One might be higher, one might be lower, but then whoever is getting the gain can defer it for future this thing because the sale did not happen. They have exchanged it's like barter system in a glorified way. Okay. Understood, right? Please write the next question. What are advance payments for services? What are advance payments for services? So let's suppose your business is following cash method. So what are the different types of accounting methods that you have understood? Accrual, correct? So in cash, you will report income when you receive. In accrual, you will report income when you have earned it. The difference is income when it is received, income when it is earned. So advance payments that were received for services. Let's suppose your corporation is following cash method. The moment you receive it, you will have to report all that income in the current year itself. Even though for 3 years you are getting the income, advance payments is what? In advance you are getting the payment for your services. Let's suppose you are what example can I give? You are an enrolled agent, and then for 3 years in advance, one gentleman has paid you for his tax filing, audit protection, all that services. 3 years in advance you take. I'm filing with you, he said, and then he's filing with you. So just because he is your friend, you cannot exempt all that income. 2023 he paid for 2026. You have received it now itself. There is no restriction on the, it is not post-dated check where date is mentioned somewhere else. You have received cash. You have to mention it in 2023. You cannot say I'll defer it to 2026. But there is an exception for accrual basis. Let's suppose you are on an accrual accounting method. You have earned it, but then you did not yet receive it. Okay, you are following accrual method. So there is a small exception in accrual where only up to the following year you can defer it. You cannot say rest of the income I'll show it in 2026. Only up to the next following year you can defer it in accrual, but in cash, as it is, whenever you have received it, you have to report it. Understood? Difference between cash and accrual. So let's understand. Advance payments for services are generally taxable in the year it is received, even by an accrual basis taxpayer. Okay. However, an accrual basis taxpayer can elect to accrue income for advance payments for the year of receipt of the advance payment using the same figure used for financial accounting purposes, with the remainder of the advance payment reported as taxable income in the following year. Regardless of the number of years of service that are to be provided. Let's suppose you got the income for 4 years in accrual. You cannot say in 2027 I'll report. Only up to the 2025 you can take exception. The following year you can defer your showing of your income. You cannot say third year, fourth year and fifth year. It will not be allowed. The taxpayer cannot postpone the recognition of income beyond the year following the year of advance payment. Understood? This election to defer some income into the year following the receipt of the advance payment does not apply to advance payments received for prepaid rent, interest, and insurance premiums. So you mark this as very important. The moment you see the word prepaid rent, it is taxable on the current year itself. Does not matter you are following accrual or cash. Prepaid rent is taxable in the current year. That's all. It will be on the exam. Prepaid rent is taxable on the current year. Does not matter you are following cash method or accrual method. Okay. So what are the other advance payments are taxable in the current year? Prepaid rent, interest, and insurance premiums. Okay, these are all taxable in the current year itself. In these situations, the prepaid payments must be fully reported. In the taxable income in the year received. Understood? Next question. What are different types of income? What are different types of income? So let's understand there are three categories of income. There are three categories of income. So you can form an acronym called PAP. PAP. Portfolio income, active income, passive activity income. PAP. Portfolio income, active income, passive activity income. Active income and passive activity income, portfolio income. So what is portfolio income? Portfolio income is, as you have seen in the previous slide, it contains interest and dividends. Portfolio income. Do not compare passive income with passive activity income. They are not the same thing. Although some of these items seems passive in nature, they are by definition excluded from passive activities. The categorization of income is important because passive activity losses generally cannot be offset against active income or portfolio income. Understood? You cannot offset passive activity losses with active income. That is a thumb rule. Passive ni passive toti offset cheyali. Active ni active toti offset cheyali. Okay. Please write next unit. Business expenses. Unit 2, business expenses. What are business expenses? What are business expenses? Any business will have expenses, right? Without expense, can we generate income? No. Huh? Label lottery రావాలి అదే కదా లాటరీ కూడా ఇన్వెస్ట్మెంట్ ఉందా అది ఎక్స్పెన్స్ దట్ ఈస్ ఆల్సో ఎక్స్పెన్స్ yes or no or else you should take a dowry even taking a dowry if you are taking a dowry I mean I'm not quoting anyone even you're taking a dowry will there be expenses or no so yeah marriage and day-to-day activity expenses all those expenses are also expenses so you without expenses there will be no income so without hard work will there be success without income without expense there is no so if you want to generate income first mind your expenses there so what are the basic expenses that we need to understand different kinds of expenses like startup expenses organizational cost all those we'll look at in detail for an entity what are the expenses so what are expenses business expenses are the costs of carrying on a trade or business yes or no for carrying on a trade or business what are the costs that are incurred they're called business expenses and are usually deductible if the business operates to make a profit and are usually deductible if the business operates to make a profit any business that you start it should have the intention to make a profit that is the sole motive right anyone who is doing business what is the motive to make profit not for charity or not for creating shell companies just for the sake of it create some dummy shell company show all losses on that particular business and then cook books that is not the purpose of starting a business right however some costs must be capitalized and depreciated or amortized meaning whatever expenses are not deductible in the current year they will be capitalized over the lifetime of the asset capitalized over lifetime of the asset meaning the shelf life of the specific asset for commercial this thing there will be shelf life for a rental this thing real estate the shelf life will be different for 27.5 years or 30 years amortization you know right like installments depreciation is you can depreciate that particular asset based on its value its shelf life so you will use form 4562 so some assets are depreciable some are non-depreciable like land you cannot depreciate only buildings and structure you can depreciate so just because those are business expenses not everything will be deductible on the current year return some will be capitalized some will be depreciated some will be amortized to be deductible a business expense must be remember this it should be ordinary and necessary you cannot plan a small honeymoon to Maldives then showcase it as your personal business expense is it ordinary and necessary you are traveling to Maldives in a business class or chartered flight it will cost $100,000 is it really ordinary and necessary for the business are you are claiming that particular expense as a deduction in your current return for your partnership is it ordinary and necessary in nature what is ordinary and necessary electricity it should be ordinary something that is meaningful and necessary which is not we cannot avoid it something very necessary like infrastructure like website like something very fundamental that is acceptable by IRS only those expenses are deductible ordinary and necessary you must have learned all this in your MBA finance right ordinary and necessary you should have heard the term so an ordinary expense is one that is common and accepted in the taxpayers industry it is common and accepted in the taxpayers industry a necessary expense is one that is helpful and appropriate for the particular trade or business that is the definition ordinary is something that is common and accepted in the taxpayers industry Necessary expense is something that is helpful and appropriate for the particular trade or business. Okay. However, an expense does not have to be indispensable to be considered necessary. Okay. So, just for our whims and fancies, we cannot say all these expenses and then deduct everything on the return. That will not be allowed. Okay. It should be ordinary and necessary in nature. What are, next question, what are startup and organizational costs? What are startup and organizational costs? What are startup and organizational costs? Business startup costs including checking whether to open a business, legal cost to purchase an existing business, and training new employees before the business actually opens. All these are startup costs. So no. In order to first open a business, some kind of a research you should do, right? Will it involve cost or not? All those can be termed as startup costs. So if you are going to buy a existing business, so you want to go and buy Google Charters. Google Charters is already running. Maybe its counter is daily 5 lakhs. You want to take over that particular food and beverages industry you want to start. Purchasing an existing business also is part of startup and organization cost. Training new employees before the business actually opens. You have started a firm. You want to refer all your employees to Agastya Tax Academy to get prepared for enrolled agent license. So the training cost is also part of startup and organization cost. Startup costs are amounts paid or incurred for creating an active trade or business, investigating the creation or acquisition of an active trade or business. Okay. The following costs related to a new business may be deductible as current expenses without the need for amortization. The following costs related to new business may be deductible as current expenses. You can deduct as current expenses without the need for amortization. What is amortization? Paying in installments. Up to $5,000 to organize a corporation, partnership, or LLC. So, what are the startup and organizational costs to organize a corporation, partnership, and LLC? There is a cap amount of $5,000. Anything above $5,000 needs to be amortized. Up to $5,000 it is allowed. Up to $5,000 of startup costs. In order to currently deduct startup expenditures, the taxpayer must elect to deduct these expenditures, and they cannot be deducted until the year the business begins. Okay. So even you without even starting the business, you cannot straight away deduct these particular startup costs. Business should be functional. Okay. If organizational or startup costs incurred exceed $50,000, there is a dollar for a dollar reduction in the available immediate deduction until the current deduction for either item is eliminated. Okay. Let's suppose your organizational and startup costs they exceed $50,000. So the current deduction will be reduced dollar to dollar until that particular startup, whatever cost that you have incurred, is eliminated. Okay, up to $50,000 is the cap for organizational or startup costs. Okay, organizational costs or startup costs that are not currently deductible, can be amortized by. What is the life that can be capitalized or amortized? 15 years, meaning 180 months. 15 into 12 is 180, right? 180 months. You can amortize. On which form? Depreciation. The moment somebody says depreciation, the form should come as 4562. 4562 is the form for depreciation and amortization. The amortization period starts with the month the taxpayer opens the business for regular operations. Let's suppose you have bought a business or you are starting a business. You are not yet functional. Without even being operational in the business, you cannot claim straight away depreciation and amortization on the expenses just to reduce your taxable income. The business should be functional. Let's suppose you have started the business on February 1st. From February 1st, whatever is there, you can claim on depreciation and amortization form. You cannot say in November all these expenses are made even before incorporating your entity, corporation or LLC. Okay. What is the form? Form. So what is this form? Maximum amount under section 179. So depreciation, there are various methods of depreciation basically. There is a method called straight line depreciation, accelerated depreciation. There is one more method called MACRS. Modified accelerated cost recovery system is a method. These are all depreciation methods that people use for different entity types. So there is one more depreciation method called general depreciation system, I believe, GDS. We'll understand all those depreciation methods and all. Here you can see some methodologies here. You can see other depreciation including ACRS. ACRS is accelerated cost recovery system, I believe. MACRS, you can see part 3 here, MACRS. Modified accelerated cost recovery system. So these are the different methods of depreciation that is allowed. So in each method, there is a different format. Up to what percentage can you depreciate? What is allowed, what is not allowed? All that we'll look into. Okay. Example. NASA Sciences incurred. NASA Sciences INC. INC is a incorporation. Okay. Incurred startup expenses of $51,000 in the current year. How much is the startup expense? Which includes wages to train new employees before their first stores actually open. NASA Sciences is $1,000 over the $50,000 phase out threshold limit. How much is over? $1,000 over 50,000 phase out limit. So it must reduce its deduction for startup expenses by the amount that is over the threshold. NASA Sciences can deduct $4,000 of its startup expenses. $4,000 of its startup expenses. 5,000 is the allowable deduction limit for startup minus $1,000. That is excess. The remaining amount of startup expenses, that is 47,000, must be amortized over 180 months. Okay. Other example, Dabur INC opened for business on November 1st. Prior to opening, the company incurred how much? $21,200 of startup expenses. $21,200 of startup expenses for advertising and new employee training. Okay. Since Dabur had less than $50,000 of startup costs, the company can deduct the full $5,000 on its corporate tax return and can also claim $180 of amortization, $21,200 minus $5,000. The cap limit is $5,000 organization cost. So 21,000 minus 5,000 divided by 180 is equal to $90 per month into 2 months, November and December. Why November and December? It opened on November. Tax year is ending on December. For these 2 months, you can claim $90 per month plus $5,000 organization cost. So amortization at 2 months $180 plus $5,000. Overall, it can deduct how much? $5,180 for the year. Understood? So for today, we'll stop here. Okay. So we'll continue with the rest of the topic and rest of business expenses in our next class. Okay. So remember, whatever just in the it's all in your head. Change your mindset, change your life. Okay. Happy Diwali once again. Thank you.